Good afternoon, everyone, and welcome to Prestige Wealth Management Group's second quarter 2023 economic and financial markets update. On today's webcast, you're going to hear from Prestige Wealth Management Group's CEO, Roy Williams, Senior Portfolio Manager, Paul Esposito, and Wealth Advisor, John D'Angelo. Just a couple of housekeeping items while we are still waiting for a few people to join. We will not be able to take any live questions today during the webcast, but if you do have any questions, please feel free to contact us at pwm@prestigewmg.com, and we'll be sure to answer the questions that you provided. With that, I'm going to pass it over to Paul Esposito to get us started.
Great. Michael, thank you very much. So as always, everyone, we're just going to provide a brief overview, sort of the state of the U.S. economy, talking obviously about how the Fed's been managing its trajectory on inflation. Then we're going to discuss a little bit more in detail performance and prospects within the equity and fixed income markets, and then wrap things up. So I guess before I get into the crux of the data, I think it's very interesting to note what a difference a year makes. So if you look back at June of last year, the markets were close to their bear market lows. Bond prices were also experiencing some troubling times with high single-digit losses. Inflation was running at 9%, and the Fed just started ramping up their super aggressive rate hike policy, which was causing earnings to stagnate, and GDP growth was in turn looking very bleak for the U.S. Fast forward to June of this year, the markets have recovered most of those bear market losses in stocks. Bonds are actually nicely positive for the year. Inflation, if we look at June's print, has come in around 3%. And based upon the Fed speak with yesterday's rate hike decision, it looks like the Fed might be close to ending their rate hike cycle. So, and looking at the outlook for earnings and GDP growth actually now looks a little bit more promising thanks to the resilience of the consumer. Of course, within that time frame, there have been many pundits that have been skeptical of the market recovery, many continuously calling for recessions last year and even this year. They keep kicking the can down the road. We are finally seeing a strong sentiment shift among many economists, most notably Dr. Jeremy Siegel, this Monday, just reversed his outlook for an economic contraction in the U.S., which I find to be I guess, very interesting, given his stance, within the last couple of quarters. So in looking at the Q2 GDP growth, that number was released today. The real GDP growth for the U.S. economy reached 2.4% on an annualized basis. And, the significance behind this is, really look at how sentiment has been driving consumption. If you look at the U.S. consumer, makes up 70% of GDP growth. And coming into the quarter, the Atlanta Fed, started out at I would say, a very optimistic level. But again, with the Fed overhang in their policy and with, some concerns for output, adjusted things down. I must say the Fed did a wonderful job. The Atlanta Fed's GDP now number came spot on. This reading was pulled as of the 18th, as of last week. They were vying for 2.4%, and that was at the top end of, if you look at the blue chip consensus range. And looking at just some of the news releases today, it's very evident that the U.S. economy looks to be growing at a healthy pace. Durable goods orders are just today have seen the largest spike in the last 3 years for the month of June. So when you factor in, non-defensive aircraft, parts, and new orders, so it's not just, the consumers that have been driving most of this. It's also been companies reestablishing confidence in order to make those large capital expenditures on durable goods. So in looking at what's really driving our economy and that GDP growth, you kind of have to look at how resilient the unemployment rate has been. So June's number came in at a very low 3.6%. It's one of the most historically low numbers that we've seen in decades. The unemployment rate is most notably going to be responsible for the level of consumption that we've seen. Obviously, the high level of inflation has called into question the consumer's ability to purchase items and to stay afloat. Yet when you're gainfully employed, it's an easier proposition. It's easier to overcome the higher level of inflation, and especially if the Fed is doing their job at bringing that level down, it makes it a little bit easier. More importantly, if you look at hourly wages in the private sector, they're up 4% from the prior year. So we're at $33.58 for average hourly earnings. I think we were at around 31 and change as of June of last year. So, for wage earners, getting a 4% increase when you look at June's figures, and then when you put that into context that CPI for June only rose at 3%, means that the consumer might be, finally starting to see some relief in, cost pressures, which again, I think is very constructive for future growth potential. You can't talk about unemployment without looking at the other aspects of labor demand. The JOLTS numbering jobs openings has come down. So we're no longer at the 12 million figure that we were toward the end of 22. But in looking at that number relative to layoffs, about 1.5 million as of May, the number of layoffs has trended up slightly toward the end of the quarter. But again, the number of available openings is more than sufficient. And there's approximately 6 jobs open for every individual that's laid off. Last year, the tech sector.
Well, I think that reflects in the jobs numbers that come out, where they show that they've been coming out higher than expected. So even though unemployment, stayed level, the jobs numbers, there's always more jobs created than the Fed expects because of, the situation.
No, that is true. Today, if you look at the initial jobless claims numbers, they're actually at one of the lowest lows in the past 5 months. So that unemployment figure is probably going to continue to stay ratcheted lower. Even if jobs availability or jobs openings start to decline, you're still at a very noticeably large ratio there when compared to previous cycles. So again, very constructive on the labor front. And looking at inflation, as we stated earlier, the inflation rate, at least if we look at headline inflation in the U.S., went down to a 3% annualized figure on a year-over-year basis as of June. When you put that in the context of how we're doing relative to the rest of the globe, we're doing a very good job, or at least I should say the Fed is doing a very good job of curbing inflation. So looking at U.S. versus the Euro area, Japan, UK, if you look at the bottom chart, you'll see that, in 2000 into 2020 into 2021, represented by the light blue line is U.S. CPI. That started to go up, right? So early March, we started to see a huge spike in inflation. That was probably the time where everyone was most critical about the Fed not, really ratcheting up their policy. Of course, the Fed didn't waited until March of 22 when, inflation was already approaching high single digits. So we were sort of ahead of the inflationary spike curve, whereas our counterparts in the other developed markets, Europe and Japan and the UK, their increase, their spike occurred later on in 21. So if you look at where we are now, we're, I would say, nominally ahead, especially when it comes to areas like the UK and Europe, when we look at headline inflation. And looking at where we are at nominal-wise in reference to the Fed's target rate of inflation, we're not that far off. So I think this kind of corroborates the thought that the Fed very likely may only have maybe another rate hike in store until they either pause or have to look at cutting things. So again, it's another component that makes things very, very constructive for the equity markets and the economy in general. And with that, I'm going to pass things off to Roy, who's going to talk about the one area of inflation that really hasn't been curbed as much as we'd like to see.
Yeah, when we look at, housing, inventories are very, very low. If you consider people were able to refinance at 3% or less for many, many years, is it advisable where somebody who's in a starter home, now they want to move, but they'll pay double for their house because mortgage rates are over 7.5% currently. So, housing inventories are staying down because people are staying put in their existing homes because of the cost of money in terms of mortgage rates. Home equity loans, the same thing. They're 7 to 8%, depending upon the bank you're using. So it's, housing has really, really held up for the past 3 years, and it really all comes down to inventory. If we look at a client of ours, child wanted to buy a new house in the Millburn, Berkeley Heights, Summit area, and one house they bid on in Berkeley Heights had almost 30 bids and went for $150,000 more than the asking price. So if you're within commuting range of New York City, a half-hour commute with a high-speed train, it's even significantly higher. And even the area of Flemington has held up. Housing prices, Florida has held up, the Carolinas has held up. What we're seeing new home builders do is they're not, because their cost to build the homes has gone down, with the wood coming down from $1,400 to between $450 and $550. It's been in a range. They have extra capital, and what they're using that capital for is to buy down mortgages for new homeowners. So you may see advertised where they'll give a new home development, may give a mortgage of 4 to 6%, depending upon how desperate they are to sell homes. Then we look at, housing starts, even though that's, picking up again, that inventory takes a while to assimilate into the marketplace. And
I think it really, Roy, is the combination of low inventories, part of it just being, existing homes not being out there for the mortgage reasons that you mentioned, and then new homes being constructed and not being, being built to spec. Most builders have wised up from the 2007, 2008 oversupply issues, and they're requiring capital up front, and they're not building their next project until they actually have a buyer in sight.
Yeah.
And then you put that in the context of just vacancy rates being at a multi-decade low. It's going to be buoyant for prices, both in rents and both in home sale prices.
Yeah, and rentals, there's significant development going on. You go to Millburn, is where the Saks building used to be. They're building rents are very, very high, but they're building a new development. In Basket Ridge, they're building a development. I think it's going to be over 1,000 units of rentals. You look at Flemington, where the outlets were, they're developing that into apartments across from Costco in Flemington Apartments, and also where the indoor baseball field used to be, Jack Cuss's, that's apartments too. So, inventories are going to pick up, but as they're building these rental developments, they're being absorbed too by demand for them. It'll be interesting to see how the demand continues to increase as we go forward. So personal savings rate, even though the personal savings rate, has dropped, the consumer is still very strong. If you just look at airplanes, every air flight I've been on is full. This morning, I was looking at booking a cruise for the whole family, all the grandkids, to go to Alaska for next year. There's a couple of cabins left in all the categories, that's over a year away, and the inventory is there's no inventory. So the consumer, when I look at real life experiences and traveling and renting, homes or whatever it may be, consumer is still relatively strong, even though they may not be as strong as they were when they had all that additional money coming in from COVID. They're still very strong, and they're willing to spend, we're seeing revolving credit pick up. It's still within a manageable number, but that's picking up too. The use of revolving credit, and the excess savings obviously is picking up too, from where it's been. So I think the consumer is in very, very good shape, and as Paul alluded to, it's because unemployment is low and you have wage increases. So and if you think about the retirees, they had a nice increase in Social Security this year of over 8%. So again, that helps offset inflation and gives them additional dollars to spend.
Also, presently high cash yields. I mean, there was a big drop off. You look at the personal savings rate, 2020 into 2021, obviously all of that. But yes, the personal savings rates have certainly added to that.
In terms of the Fed, we had an increase yesterday. There was I'll round up, a 94% of having an increase yesterday. Went up a quarter. It was already built into the market. That's why you didn't see the market react much. But what's amazing is to watch the market volatility as the head of the Fed is speaking. Mr. Powell, it's amazing. We're up 200, we're down 200. Then he says something else, and now we're back even. Now we're up again. So everybody hangs on to every word in his commentary. So the interest rate increases, we're hoping that we don't have another one, but we very well could have one in September, but we'll have to wait and see. It depends upon how all the economic numbers come out and how they feel. The good news is, again, as Paul said earlier, inflation is coming down. So hopefully they, relent to stop increasing rates. If anything, as we get into next year, most likely you'll see the Fed start decreasing rates. As you see going into 24, the percentage in terms of rate cut increases significantly. So we'll see how it plays out. With that, I want to hand it over to John.
Yeah, thanks, Roy. I appreciate it. This chart is going to show S&P 500 valuation. It's a chart we look at pretty much every quarter. What you've seen since the last time that we did a webcast is that you've seen valuations kind of creep up a bit from the averages. I'd say last time we were at about 16 and a half times earnings. We've creeped up to about, call it 19 times earnings. I think that has a lot to do with what we've seen so far this year, where we have a very narrow, I call it very narrow movement in from a standpoint of the markets, right? So we've seen 5, 6, 7, 8 companies which dominate the indexes kind of roll up on I'd say this new technology that we've got, which is artificial intelligence. So based on AI and AI expectations, some of these mega cap companies have kind of seen their multiples rise, and because of that, you're going to see a rise in multiples across, I'd say across the board. So, let's talk a little bit about the composition, valuations, and earnings. I talked about those top 7 stocks, and they are responsible for 82% of the return this year up till a couple of days ago. You know, so that distortion is coming from, you know, these law call it these mega cap tech, communication, and discretionary names that have dominated the index. Names like Microsoft, Apple, NVIDIA, Meta, who reported earnings overnight, and such. We did see recently, a couple days ago, we did see a reconstitution in the NASDAQ 100, where they're trying to rebalance their portfolio a bit to try to compensate for some of these larger than average weightings in some of those names. You might have seen a little bit of volatility late last week in a few of those bigger names. So the multiples for those stocks are around 29 times earnings, which is a bit of a premium to historical averages. We're probably going to see over the course of the next, you know, year or two if those premiums are justified based on, I would say, some of the prospects for artificial intelligence. You know, we might see earnings either catch up and see these multiples come down because of stronger earnings that come from some of these new technologies, or, you know, you might see a repricing of some of these mega cap names. Might in the short term see that anyway, because, you know, some of them are probably a little bit short term overbought because of some excitement that we've seen in the market around some of those names, which, you know, could be an opportunity for the S&P to gain a little bit more breadth of returns. Just something we've talked about as a you know, as a committee, as an investment committee over the course of the last month or two.
You still have 490 names that are, you know, trading at a 17, call it 18x multiple, which again, I think given the conditions, given the outlook for where rates are, is pretty favorable. And then if we break the market up between growth and value, growth inevitably is going to have a higher multiple, let's call it 22. On the value end, we're still at about 17 times forward earnings, and some of the deeper value areas is even lower. So, you know,
when you look at pharmaceuticals, most of the year have been negative returns. Well, in the healthcare sector.
Just like last year, right? The three horsemen last year were tech, consumer discretionary, and communication services, right? And then obviously a lot of the value sectors, value-oriented sectors, energy, staples, healthcare, were the bastions of stability. This year, it's the flip side. You have those three being the three best performing sectors, and represented by, call it the seven, right? The super seven, I think now is the term that they're using for them.
You know, it's interesting. We've seen this rotation, re-rotation, and rotation back, right? So if we think about the cycle since 2020, you know, we saw these mega cap names. You know, you can see it from an earnings contribution in the chart. You know, during, you know, COVID, when we had, you know, remote work, it was those few names that led the market's early recovery while we watched a lot of these value positions lag incredibly. And then we had that reopening of the economy, which caused a re-rotation back into some of these value names, which really carried, you know, the markets, while some of these mega cap tech names kind of took I'll call it a siesta.
Yeah. I just want to remind people that when you lose 50%, which a lot of the big name tech companies did lose 50% last year, you need to go up 100% to get even. The numbers aren't linear. If you lose 20%, you need to come up 25%, but if you lose 50%, you have to come up 100%. So, you know, we try, you know, with our clients, try to manage volatility the best we can by having a well-diversified portfolio.
Right, and I think that's a great point, Roy. That in and of itself is the value of diversification and proper asset allocation in a portfolio. This way, you're participating, you know, in all environments. You know, it's sort of that lily pad approach that we try to avoid. You know, jumping from lily pad to lily pad and simply missing out, not getting a return because you're not in the proper names. Or
one takeaway that I have from at least the earnings contribution, because if you look at, you know, historically speaking, every time earnings have been clustered within, call it, 25 plus 30%, plus of the earnings get clustered in 10 names or a handful of names. Usually that tends to be detrimental for market future returns. So it is comforting to see that, although, the tech sector, communication services, and consumer discretionary stocks, right, those 7 have really led the market this year. They're still not responsible for as much earnings as they were at the peak in 21. Going back to 08 and 09, you saw the same thing. And even, during, the early 2000s, you saw that similarity. So just an interesting relationship to call out.
Sure. So let's talk a little bit about the corporate earnings trend now that we're kind of in a I'll call it full-blown earnings season. 70% of S&P 500 companies are going to be completed, I guess, reporting by week's end. We've seen 75% reporting positive earnings surprise, 61% of which reporting positive revenue surprise. I think we could kind of tie in some of the things that we've already talked about when we think about where corporate earnings are and maybe headed. We're seeing inflation continue to ease, and we've seen pretty resilient GDP at the same time. Low employment, but higher than expected interest rates. So, it looks like we're going to see potentially we'll call it an earnings growth recovery as we move forward into the second half of the year. Specifically, I'd say it's been when we think of some of these bigger names that have reported, whether it's either some of the financial names, some of the technology names, some of the communication services names. I mean, it's been pretty consistently better than expected. And as we see the potential for inflation to ease with these higher rates, and as long as the consumer continues to stay strong, we could look at continued recovery as we go forward. Let's look at.
I just want to comment on recovery, but we can have certain events that can cause some volatility as we continue to recover.
Yeah, and I think we've talked about some of that, right? I mean, without the market having breadth, I mean, as long if we only have 10 names participating in a in what we'll call a stock recovery year, we don't see some breadth of returns. Very easily see a correction in the stock market just simply by seeing those 10 names have a short-term retrenchment, which would be nothing more than just overbought conditions, could cause markets to have a call it one of those 10% hiccups that we see typically a couple times a year. And when we look at this forecasted range, I mean, the good news is that this is an interesting chart where you're seeing as we go forward from 23 to 24 to 25, where we're starting to see the expectations that at some point potentially in 2024 we may be at a recovery point where the markets have recovered what they lost in 2022. And like I said, I mean, I think it's going to be important, I guess, for the consumer to remain resilient and employment to remain resilient with these higher interest rates, because one of the tough words to say is the big R word, which is recession. If interest rates went too high, I guess that's really what the future, the most important part of the future, whether we're going to be the low end of these ranges or the high end of these ranges, are does the Fed get it right? I think one of the things from yesterday, Roy, which was really great, that came out of Chairman Powell and his interview, I guess, post release of the numbers, was that they're going to be data dependent now. Yeah. They didn't just positively say that they're going to raise interest rates at their next meeting without the data, confirming that they need to raise interest rates again. So even though the expectations are maybe one more hike, when we look at markets, and we'll talk a little bit about the fixed income markets as well, we may or may not see another hike depending upon that data. So that was a positive point. So let's look at the fixed income markets. If you look at the top of the chart, you can see that the short term of the market is still and has been for quite some time inverted, and that's simply the Fed is pushing as hard as they can on short-term interest rates as they raise that overnight lending rate over and over and over again, which we've seen over the past year or two. What you're seeing is those short-term interest rates, substantially higher than some of the longer-term interest rates, which is a pretty interesting curve. But when we look at the back end of the curve, what you're seeing a potential, at least anyway, for and if you look at the bottom of the chart, that 2-10-year spread, that by sometime in 2024, perhaps sometime between I'd say Q2 of 24 and maybe Q1 or Q2 of 25, we may see a normalization of the curve occur, which
and what can happen a lot of times, and people don't realize, you can have short-term rates drop, and you can still have long-term rates go up from here. So you want to be very careful, buying 30-year bonds, because if there is an interest increase in 30-year bonds, it could be a significant loss in a portfolio.
Yeah, absolutely. Let's move on to fixed income markets. This is a interesting chart. It's focused, I think, mostly on the green. I call it the dark green and the light green bars, as opposed to necessarily the percentile ranks. But I think it's important to note that when we look at yield to worst versus current yield, that there's potential possibility for some fixed income recovery over the next year or two. Especially if if interest rates especially peaked, which is also a possibility. So the first half of the year, let's also note that we got about a 3% return, positive return. It's encouraging.
May I interject?
Sure.
That has just been yield. It really hasn't been any price movement.
Right, and it's the first time in a while that we've had what I'll call even a decent return. When we think about the bond markets, over the course of the last decade, and it is the first time in quite some time that we've had yields, at least short. Even on the longer end of the yield curve, they're pretty good. On the short end of the curve, we haven't seen these type of yields in quite some time. So investors are enjoying, to your point, when you're talking about the personal savings rate, they're enjoying higher cash rates, bank balances. You're at least getting a return on, and like I said, we've seen a what I'll call a decent return.
And you got to be concerned about from a tax standpoint, because it's been years since there's been a higher cash return. So you want to make sure that you're paying enough estimated taxes and that you're paying enough taxes in. Because I've seen clients with significant amounts of cash, maybe now if they have $250,000 in cash and they're earning 4%, that's added, you're adding another $10,000 to income.
Excellent point. And then finally, I guess we could talk a little bit about the bond portfolio where we've got an allocation across both high yield and convertibles, and it's in essence really where we think there's an attractive space. Correct? Right? Am I wrong?
That's a play on recovery. Expecting the economy to continue to recover and improve. As we go forward, as Paul and I talk about, there was it's been not a true recession, but secular recession in certain sectors. may have been recessionary, but, even though we overall did have a recession, so, that will continue to improve. Next, in terms of cash opportunities, I really want to bring this up regarding cash. Yesterday, a client went out and bought a CD, 1-year CD for 3%. That may sound good, but we could have got them over 5%. A lot of the local banks, I'm not going to mention names, they don't pay, especially the bigger banks, they don't pay great CD rates. So if you need CDs or want to buy treasuries, sometimes treasuries a better yield. And, you may want to go out 5 years, 4 years, 3 years, and ladder your bond portfolio, not bond portfolio, but your CD portfolio or cash equivalency portfolio, ladder it, because even though right now the 1 year gives the best yield over the 3 and 5 year, when the Fed starts decreasing rates, depending upon how far they go, they're not going to go back to zero where we were since 2008. We were very, very close to zero. That expectation is not there that they're going to go that low, but we'll continue to get healthy yields compared to where they were. And we want our clients to maximize the yields that they get. So please call us before buying a CD from the bank. We'll tell you in terms of what the treasury yields are. When we buy CDs, we buy them on a national basis. One client said to me, "Why didn't you tell me about that before?" Well, because until recently, we had no yields, and there really wasn't much disparity. But now, instead of going to a bank and getting 3% like a client did yesterday, we can give you, over 5 for 1 year, maybe using a treasury, and it's state income tax free. So with that, I want to hand it back to Michael.
Thank you guys for joining us today. Just as a reminder, this webcast will be recorded, so you will get an email with the replay on it. Again, if you have any questions that we didn't address during the webcast today, please email us at pwm@prestigewmg.com, and we'll be sure to get back to you. Thanks again.